Welcome back, ladies and gentlemen. Building a thriving asset management business is not just about creating investment products, it's more about generating good returns. It's also about consistently delivering alpha, impeccable operations, and effective client communication. Earning investor trust is not easy, and scaling asset management business requires all this and much more with zero scope of any mishaps. With increasing regulatory compliance, evolving investor sophistication, and growing competition, how to build a profitable asset management company along with delivering on the investor promise of outperformance. To provide a well rounded view, we have three distinguished speakers from three different spheres of asset management, each offering a unique perspective. Let me introduce the three panelists to you. We have with us Mr. Anunaya Kumar, Senior Executive Vice President and National Sales Head, 361 Asset. Mr. Anunaya Kumar is a seasoned financial services professional with over 2 decades of experience across corporate banking, retail banking, and wealth management. As the Senior Executive Vice President and National Sales Head at 361 Asset, formerly IIFL Wealth and Asset Management, he is focused on building a robust retail franchise and positioning the firm as a leader in asset management. We have with us Mr. Umesh Gupta, Head PMS and Portfolio Manager, Ambit Wealth Management. Mr. Umesh brings over 22 years of extensive experience with 17 years dedicated to the Indian stock market. He has held key leadership roles including co-head of equities at Ambit Global Private Client, head of equities at Avendus Capital, and portfolio manager at Reliance Private Client. Notably, he was a top-ranked portfolio manager from 2013 to 2018, delivering an impressive 36% CAGR and a 5x absolute multiple over the period. Mr. Umesh holds a BCom and an MBA from IMT Ghaziabad. We also have with us Mr. Ashish Goel, Managing Partner and CEO, Invest Savvy. Mr. Goel is a highly accomplished investment professional with over 25 years of experience in financial markets across India, Singapore, the UK, and the USA. He holds an MS in Computational Finance from Carnegie Mellon University, summa cum laude, an MBA from IIM Calcutta, rank holder, and a BTech in Electrical Engineering from IIT Kanpur. And this session will be moderated by Mr. Mohit Bhagat, who is the Head Channel Business Development at Alchemy Capital. A senior financial services professional, Mr. Mohit Bhagat has an experience of over 20 years in asset management and wealth management business in India, and he has served in various positions and geographies with firms like ICICI Bank, ICICI Prudential Mutual Fund, Franklin Templeton MF. Academically, he is an MBA in finance and an IMC alumnus who has been associated with Alchemy Capital as head of their channel business since January 2017. It is now over to our moderator, Mr. Mohit. All yours.
Thank you, Shwarya, and good afternoon to one and all out there. Well, it's good to have you guys out there, post this lunch session into this very interesting session where we're going to talk around one of the most intriguing topics, which basically goes through our minds out there. And as Kamal, while we were talking about this topic, also rightly said so, this is a topic where primarily we feel that it is close to most of our hearts out there. So the topic that we're covering around here is talking about building a profitable asset management business along with the promise of outperformance. Now, what we're going to do out here is let's break this overall topic into two very important spheres, which is the first part of it, where we're going to talk about building a, profitable AMC business, right, which is both amongst, MF or on the alternate side with PMS and AIFs out there. And then we're going to cover up the second part of it, which is the profit to outperformance, because what I feel is these are two very intriguing topics which require a little focus out there before we marry them and come back on the consensus understanding. Thanks to the esteemed panelists out here. So what we're going to do out here is let's start by the first piece of it, which is about building a profitable AMC business. Ashish, I'll start it with you since you are in the built-up stage of the first a PMS and AIF organization. And this is the initial stages where you're building it up. I'm sure you just on course been experiencing these things on a practical basis. Pragmatism is chipping in more with you. So given to your experience, what do you feel about this overall juncture and the understanding of how do we build up a profitable AMC business in India?
So thanks, Mohit. And it's always the first one carries the baton first. So we are starting our firm out. We are about 3 years into the business. And I look at building up a AMC very much like building a company. So, I'm sure most of the participants here are investors or are linked to equities and have an interest in equity markets. So, like you look at any company, uh, the first thing which we look at is uh, about the management. So, you have to have competent management, they have to be honest, and there has to be continuity. They have to have skin in the game. Same is the case with any PMS or AIF, that you have to have competent people. They have to have constant continuity. You wouldn't want a firm where management keeps changing around, fund managers keep shuffling, that kind of thing. Uh, you would want them to be honest, and they should have skin in the game. Good governance and compliance is a given. You need to have that. But I think one thing which is core to this is that I believe you have to build trust with the clients. Something which some new or old wealth management companies forget is that end of the day, you are managing something which is very core to the individual. Unlike an order, where let's say you get an order to produce something for a client, here the person is trusting with you with money, and this could actually be something very core to their lifestyle and future wealth. So they have to trust you. It is personal here. It's not a business decision alone, it's a personal thing he's getting into it. So I think you need to build trust. They need to feel that you put them first and you're not just trying to sell a product for the heck of it. Uh, and yes, you need to do all the other. Transparency is important. And eventually, the final thing, which is anyway the elephant in the room, is returns. So if you might do everything else right, but if you are not performing, then clearly, even if the guy loves you, he will have to move to some place where they get good returns.
Thanks, Ashish. I'll move to Anunaya. Anunaya, since you've basically been going around this built-up journey on both sides, on the MF side as well as the PMS side out there, now that'll be an interesting outtake from your side. That what's your view, and keeping in sight the opportunity size of the same industry in India, and we all feel that we are an inflection point. But if you may agree to that, and if you can just give a little more anecdote on that as well, please.
Thank you, Mohit, and a very good afternoon to everyone. I would absolutely agree to what Ashish started with. I think doesn't matter whether you are looking after a PMS or a mutual fund. What matters is that you build a sustainable business. That's very critical. And when we talk about sustainability, you will have to keep in mind quantitative and a qualitative both aspects. I may sound a little theoretical, but believe you me, these theories are real life. I have to look at, building a business, keeping in mind the retentions in mind, because that's where the sustainability is going to come in. I have to ensure that a product basket is good enough for someone to look at. I can't be ignorant to the market share. I can't be ignorant to ROE, because that's where I am demonstrating an efficient use of the capital. I can't be ignoring the AUM aspect. So these are the few of the quantitative aspect that I'll have to keep in mind. But when it comes to qualitative, I will also have to look at, to me, the two very, very important aspect is, well, I have felt that businesses can be defined through 5 Ps, which is product, pricing, performance, people, and a process. To me, the two aspects of the P, which is the process and the people, are very, very critical to business when it comes to qualitative part. How do you define the engagement with your client? And very nicely put in by Ashish. I do feel so that in our business, the trust is so critical. And when we talk about trust, building a trust, client has to be put right in the front. Now, when the client is in the front, then the only way where you can build this is to have an effective engagement processes. whether you would want to take it through digitalization, whether you want to look at building through brand reputation, or having an effective risk management, or even seeing to it a distribution network is robust enough for you to build a strong reach. I think these are the few of the qualitative aspects, but the fact is client keeping him the first and ensuring that element of trust is robust is very, very important. Why? Because Mohit, please appreciate the very fact in our business, each of these clients are also the brand ambassadors for us. A satisfied client, a client who has got a good experience is going to go to people to say, look, there is a fund of a 361, which we feel has been pretty good. And with a robust transparency, with a robust risk management, with a robust engagement, I haven't my element of trust is pretty high. So one should really look for it. See, performances, as Ashish said, is very, very critical. But is it something that we can really, quantify in terms of ensuring? I don't think, because at the end of the day, markets has its own dynamics in terms of, building the performance aspect. So, well, it is critical. I wouldn't say it is not. But what is more critical is the other aspect, because that's the one which is going to win. And if you are a long-term investor, believe you me, if the pedigrees are strong, performance are going to come in.
Thanks, Anunaya. Umesh, you'd experienced on both sides. You'd basically gone into more like a B2B and a B2C roles in the previous avatars. Now, while you'd actually experienced out there, and I'm sure you dealt around with the direct clients much more than the other two on the panel side. While you've done that, what has been your experience that, both of the panelists have absolutely clearly said that, it's trust that you have to build around a long period of time. Now, to build trust, you always need all the attributes been contributing. But beyond all of that, what are the nitty-gritties that you'd kind of like to focus around to build around a very successful and profitable business?
Hi. Thanks, Mohit, and thanks, PMS AIF World. So my view is that if you see in general, this is a highly rewarding industry. If you see the financials of asset management companies which are listed or wealth management companies which are listed, you find that they're best in terms of profitability, in terms of return on capital. The point is that you have to survive. You have to be able to survive through those phases to be able to tell that story. And which, to my mind, actually, I believe in performance first. My opinion is about that if you are like a performance driven organization, if you are a performance driven fund manager, then you will be able to survive, because otherwise you can achieve probably scale because of under penetration in our country right now, because financial products is only 5% of their savings. So you can achieve scale, you can achieve initial uptick because of under penetration, but in the long run you will be only be able to survive if you deliver on that promise, if you deliver to your clients. So I believe in being performance first, and then of course over a period of time you have to have that performance with a risk adjusted performance. You can't be just like chasing performance. So the risk adjusted performance is the key word here. If you deliver that over cycles, which I've seen in my career of last 20 years, having been able to do that, if you deliver that over a period of time, the trust also comes, because you can't just kind of achieve trust of clients without delivering on performance. Like narrative cannot achieve that trust. That is what my feeling is, that performance has to be there, and of course you have to be like the fiduciary responsibility which the client gives to you. You have to fulfill that.
Well, Ashish, though we wanted to come back on performance a little later, but since Umesh has already pulled us into it, let's look at this very interesting aspect of performance, because performance, and he very correctly denotified a very, very sharp point out there: risk adjusted performance. When we talk about performance, our industry has been talking about an absolute number which has been put out there, which to most of us does not looks to be the right set of performance parameter. And when it comes to risk adjusted performance, I don't think so. There are set parameters on the standardized note where you can actually go out and say that, okay, this is the way I look at it. How do you basically look at it more from a, deliverable side on your PMSs or on your products to your clients?
So, yes, totally agree with you, Mohit, that performance what we find is that sometimes we are comparing a bit like apples to oranges, because what happens is that people sometimes look at different portfolios and look at only the absolute return, whereas in reality what you need to look at is what is the risk that is being run and what is the return that is being generated. Now, clearly, you can look at the track record, look at volatility, and there are multiple ratios, including Sharpe ratio. And if we start getting into the nitty gritties of each, and each one has their positives and negatives, it is going to take a full day, not just the session. But I would say, where when we are talking about performance, it is always important to educate the clients that if they see, let's say, if our fund was one of the top performing funds for both 23 and 24, and when clients would come in seeing 70% return or 80% return for a year, I would still say always that, look, this is not really the norm. We've been lucky. Market has been very kind. Yes, there is an element of hard work and understanding, but there is also an element of markets, and you can't forget that. If you are getting into a segment which is going to go up like mad, it's also likely that it will be more volatile. So at one end you have fixed income, which doesn't move at all. It's very, very predictable, but then the rates are there. On the other end, you'll have, I think, the micro cap or like the unlisted shares and all, where it is a lot more volatile and returns can be very high. So you have to see your comfort level and you have to compare like to like returns. So performance is definitely something which is oft misused. So when you're having a good year, a lot of people will say, oh, we have given 50% return, so we are better than everyone else. But the right conversation to have is that, look, we are in, let's say, SME or more on the mid and the small caps. Whereas if you are looking at comparing with a large cap, then they are in a different space. So don't compare everything. And it's when you have, when I talk about trust, yes, performance is important. But if the client realizes, and sometimes, even it is something like, don't put money right now, you might hold on for 3 months, or don't invest right away. This is not the time. Market is volatile, or at least inform them that, look, the next 3 months can be very volatile. It is event based. Let's say we say Trump is coming up with tariffs, like January and all, there are lots of things which are happening. So you have to tell the client. Then if he wants to invest, that's his call. But at least he should be told. It shouldn't be that you don't tell the client and say, oh, markets, so, like there's this a very famous dialogue back with one of the influencers that aadmi ho ya market end mein upar hi jana hai. Now, while it is good to hear, but we've all been here that, if you go up before the market, then you may not enjoy the market going up. So you need to educate the client not to take stupid risks which he cannot take, and understand performance. Even if you are at the top of the pie, you have to tell them that, look at performance holistically. If you don't understand, please understand what it is. So I think that is very critical, and that's a big part of building trust. That even if you are giving great returns, you still tell the client that, look, these returns are not sustainable for 10 years. You might have short bouts where market is great. There will be bouts where market will not be great. So I think that comes into play.
Point well taken. Anunaya, I taking this point further, what Ashish said, what I found is, and this is a perceptive understanding of the market, that when you're trying to be client favoring and making these understandings, and as Ashish said that, it's kind of prudent to be kind of informing clients or being indicating clients, it can go either ways. And the perception on the market is that, you cannot be all the time right. You take the stand, and if does not goes your way, you have been kind of been dealt in a very different mannerism. So the ideation is, we've felt that, a lot of managers try to kind of shy off this particular stance primarily citing that they don't get any meritoriousness or any credit for going right on that, but of course they've been held around accountable for not being going right on that. What's been your take on that?
See, Mohit, it's like, I wish if I have a problem on a medical side and I also have an answer to it and I can go and take the medicine, but that doesn't work. I have to go to the specialist. Why? Because that's a specialized job. Likewise, when it comes to financial emergencies and all, I think we will have to look at and hear the managers and the advisors as they will, do their jobs. The problem is a typical behaviors. It's like in a bull market, everyone is a Warren Buffet. Everyone's view becomes big. Why? Because it's basically a Midas touch that's working. You can't differentiate between horses and a donkey because everyone is running at a pace. Maybe someone running faster, someone may not. In the bear phase, everybody becomes a long-term investor, whatever the view would be. Because why? Because the person is stuck. Now you can go back to the manager, you can blame the manager, why you haven't done a good job, blah, blah, and so on and so forth. But there are enough evidences in the history of our capital market. At the end of the day, your long-term averages vest around 15 to 18% only. So if you have a great 4 years with a compounding coming to 32, 35, then get prepared. The next 2, 3 years are going to be a little muted, come what may. And currently we are going through that phase. So what we have seen through last 4 to post-COVID is one of the longest bull phase that Indian capital market has ever seen. Now, are we saying that this bull phase that has happened and people talking about Naukri chhod, FD tod, let's get into the market, that's the best way to make your money. Is that the way the markets are ever done? No, that's not the way. See, ultimately, if you set your expectations right, that look, I am into an asset class, wherein with so much of transparency, money available at call, and a great efficient tax management post-tax returns, I'm happy to look at 15 to 18% kind of a return, depending upon what instrument have you chosen on the equity side, and maybe sub 15 if you aren't into equity at all, or maybe in a hybrid structure. Then I don't think there is a problem. The problem is we refuse to differentiate, the money making and at what quantum of risk are we onboarding when we are. Like, you can go to a casino and you can make a money, but does that become a business model? No. If you are in a sustainable wealth creation, then you have to give a longest possible tenure for your money to remain invested. Your job is to pick the right manager, the manager who has seen different cycles. At the end of the day, what is very important is because at the end of the, if we look at the market pretty much demonstrate on 4 to 5 year kind of a cycle, something happens. Something happened those 4 year cycles. So you would need to look at the managers who have seen those cycles. How have they been able to vary through those times? And ultimately, how have they really come out of it? What you would need to look at the drawdowns. In the worst times, what has been the element of drawdown in the portfolios? Has the manager been able to manage that piece well? And the most important thing, as Umesh touched upon, the risk adjusted. Actually, we only look at the shades of green. What we do not look at is at what cost have those shades come in. What we do not look at it, have those green come in through the mid caps, small caps, or are they coming in from a large cap? So I think it needs a lot of talking, lot of education to the people, and right expectation setting. And to me, the right audience for that is a group of people who are right on the as an audience, which are our friends, distributors and advisors. That is, it is their responsibility to look at the risk profiling and set the right expectations. Market, as Ashish might have put it in a nice way, market ऊपर ही जाएगा, आदमी हो या market. But the fact is, market भी उनमें से एक है. It will go up, but do you have a patience enough? That's critical.
Thanks, Anunaya. Umesh, what's been your experience? And I'll kind of leave 2 things with you, because while you've been dealing around with this set of clients, primarily the larger ones out there, the UHNIs, do you think that this is a segment which essentially have imbibed and come over this behavioral challenge that we've been talking about? And the second part of my query to you would also be, assessing that while we talk about, the topic that you mentioned, the risk adjusted return and asset allocation, as both Ashish and Anu has kind of already indicated, do the arrived set of investors wholesomely look at it, or are being imbibing to that concept yet, or we are still in this phase of being, talking around it more than kind of practicing it?
Okay. So on the first part, I believe to a large extent, yes, the UHNI and HNI category has kind of understood, has gone through many cycles. We cater to a lot of family offices, a lot of ultra HNI, and they have seen the cycles. And this is what I see, that the clients, primarily from metro cities, or the clients who have been through cycles, they are okay, and which is what we see in our products also. We don't see panic selling, at least at our end, because they understand, they have seen cycle. And the other thing is that, very interestingly, and probably a little unfortunately, cycles are getting shorter. So if you see, after COVID, now we are already in the fourth cycle of the market. So we had a one up cycle between April 20 to October 21, which was like 1.5 year. Then we had a 1.5 year of down cycle. And now again, we had a 1.5 year of up cycle. And again, going through a down cycle. So that is an unfortunate part, because that means that a lot more emphasis has to be given on risk-adjusted returns, going through those drawdown, which Ananya talked about. So this that is there, but as I said, that in an UHNI category, I see it a lot, that they kind of understand that this is a cyclical thing. Ultimately, you do make 15-20% kind of returns over the long term, depending on which product you are. On the second part of your question, I believe there I still feel that a lot more needs to be done. It requires, because as I said in the beginning, in the first part, that we are a very, very underpenetrated country from a financial products penetration perspective, and we have a lot more potential. And in fact, we saw it in the last couple of years, that our market were probably got saved because of DII and the money which we are getting from SIP. Now we have a responsibility to prove it to them that yes, there is a prudent way of managing funds, risk adjusted return, and which can happen. And this drawdown and temporary kind of cycles is something which is a part and parcel of equity investing. But I think there we require a lot more education. And in fact, as I see that industry is doing a lot more on that. For example, mutual fund sahi hai and other part. But I think there is still required a lot more to be done, especially on retail side of our investors.
Okay. Thank you, dear. Now, Ashish, I have now these couple of rounds of very interesting queries for you. And that is coming out of the gist of what we've spoken till now. And coming back to the topic of, building a profitable AMC business while you are into one of the PMS business. If I go by what Anunaya and, Umesh just said, so it seems like that the arrived investors, the better set of investors who are the larger HNIs, UHNIs, they kind of have arrived a bit relatively to the other crowd. Now, while that has happened, it gives an indication that probably, getting them into a more arrived product like in PMS and AIF would rather be relatively, I will not call it easier, but relatively seamless, right? Building that through up. But then if the behavioral pattern doesn't changes out there, how do you cope with that? And the second part, which also opens another, kind of debate is what Anunaya just mentioned about the vintage. Now, if vintage is to be seen, then how would the newcomers would be making a mark? Should they be coming out there and just proving themselves for next 3-5 years and then probably trying to look at a leap up out there? What's your view out there?
So the first part, I am not 100% sure of your question in terms of HNI, ultra HNIs, and what they want to cope with. So let me just try to say what I made of it. One is, for newcomers, this business is a time-consuming business, and one has to face that. So you cannot think of this as a dot-com startup or a new age startup which starts today and within 1 year is a billion-dollar startup. That's not how it works. You are eventually dealing with people's money, and building trust will take time. So yes, like we started out 3 years ago, we've given great performance. The whole idea is you will build it up over time. It will take 3 to 5 years at least to build it up. And that's the way to go about the right way to go about it. So you deliver performance, you show products, and as was mentioned earlier, effectively your clients start becoming your biggest brand ambassadors. So the better you treat them, the better the experience for them, and better not just in terms of returns, but also in terms of engagement, in terms of advisory. Do they, one thing which I think is very important is, does the client really feel that you really care about him as an individual and you understand him as a person? So if the salesperson or whoever's dealing with the client doesn't treats the client as a number and doesn't treat them as an individual, then clearly at some point it will not be as effective as for somebody who understands the client. So that is one. I'm sure it's not easy. Like there's a client which we have, and they had a medical emergency. So we waived off premature withdrawal, etc. But then we also followed up on what happened to the surgery and all that at a later point, and that struck a chord with them that we treat them, as an individual and not just as a number. Now, I'm sure for larger companies it gets difficult. For mutual funds and retail, you just can't do that. But for ultra HNIs and HNIs where you have PMSs or AIFs, it is relatively easier to do. So that connect or a personal bond is important. And yes, people who've been invested for a longer period are not necessarily pulling out, because somebody who invested 2 3 years ago is not pulling out immediately because they are still in positive. But yes, if the fall continues, there will be an issue with people trying to pull money out, and you need to educate them, and some people will go. So if people see fall and they want to protect their capital, or they are feeling jittery, and this is especially happening with people who were dealing beyond their means. So there were a lot of people who invested beyond what they could actually afford, like FD Tod or whatever, borrowed money, leverage and all. And that is the class of people which is really taking the hit. The longer term investors are still okay, and I think they will continue and make money. But if you want, I'm not 100% sure of the first part. So if there was something slightly different you wanted to ask, if you can just rephrase it, would be good.
That'll be perfectly okay. I'll kind of, take it to the next question out there. Anunaya, now, we all understand, and you'd also stated in the initial part of the discussion that trust is one of the most important pillars, and that's the foundation. And as Ashish said, that it becomes difficult when it comes to masses, then the classes probably in PMS and AIF to build that. That's a complex thing. How do you feel that, one can do that, and how do you do that way so that, people feel related, people feel, more of trustworthy beyond the number deliverables that we're doing out there?
So I think I have a little bit of disagreement on this piece that it can't be done on a mass. I think we have enough evidences where the mutual fund companies actually have become a household name. People only say, okay, fine, this is the AMC, I trust. And that and the individuals associated those AMCs all of a sudden becomes a great examples to quote. To me, trust is not about delivering the returns. Trust is also about how collaborative are you while building the business. So for example, awareness is very critical element of trust. So I can do investor awarenesses as a mutual fund house, nothing stops me. I can do as many programs. I can go educate people what investments is all about. They do love that. I can be pretty transparent in my disclosure norms. Even if and as a mutual fund house, we are highly regulated, but I can still use my discretion to be over transparent in my disclosures. People do love it. I can I can be more consistent on my performance. May not be trying to be quartile one, but even if a quartile two consistently over a longer period of time, people do trust it. So the element of trust, whether you are in a masses or even if you are in an ultra HNI, which are niche, maybe to me the approach might be different, because here when you are in a niche, obviously you are talking to a certain smaller segment of people, and hence your approach to talking to them would be very different. When a mass, obviously you have to have a very different approach, and that's where I started off my 1P, which is where in the initial discussion I said process. And a process is something which is playing a very, very pivotal role. And here, to me, the process would mean engagement. How beautifully am I able to establish my engagement across the spectrum, whether it's a disclosures, transparencies, education, or building or getting collaborative. I think that's where people start appreciating, and that's where the institutions do get built. So I feel that trust, yes, it can be done. Only thing is, somewhere it is less laborious, somewhere it is more laborious.
Fairly put up. So basically, I understand the overall construct that you're trying to do. Wonderful. No, guys, in the favor of time, what we're going to do is I am just going to ask you one last common question across you guys. And this would be, I'll want you to answer that maybe 2-3 lines if you can, great. The ideation is that let's go a little more, kind of, I would rather call it enhanced, thought on the enhanced thought, and think around that, if you've been given the power to actually circumvent or kind of work around only one variable within our business, which can actually work around propagating or promoting your business, asset management business profitably, and the way we want to basically set up consistent outperformance out there. If we can actually look at modifying one variable which may improve, the profile of business that we've been running, what would that be? Let's start with Umesh.
Hi. See, basically, if you see what is that which kind of scares people the most from an investing perspective, and that is the volatility. I mean, it is proven through the data that equity is probably the best asset class to invest in long run and across the world. Indian data, American data, you can see. But despite that, why people still don't invest in equities to the extent they should? It is because of the volatility of this product. And in that sense, whatever can be done to reduce volatility, and then it's like more like a wishful thinking because it is not in control of anybody to reduce the volatility of this asset class. So, what is the best that can be done to address this? Let's say the biggest point. Then the point comes is educating people. So as I said that if we can go around and educate people more on the pros and cons of investing, the cycle, they will come and go, and the client or the investor has to continue to stay put. They can do optimization, they can do some sort of evaluation of which fund manager is doing well, which fund manager has seen cycle. Those are the things fine, but we have to kind of be able to communicate to client that this is the asset class. For example, if you see, as I said that we invest 75-80% in terms of data of savings goes to the real estate. Now, why? Real estate is not a better asset class than equity, but because of its opaqueness, which is funny, that because it is so opaque, it is not transparent, and people are okay to remain invested in that asset class for far long 5 year, 10 year, 15 year. I mean, for example, last 2 months, if you see, people are questioning investing into stock market, investing into small cap, mid cap, should SIP be stopped, should SIP be increased, and all those things. Why? Just because this asset class is so transparent, it is showing you a 15% drawdown in the last 2 months. Whereas other asset classes, as I said, real estate and all, they don't show you the drawdown. So people are okay to remain invested and eventually they make money. So as I said, that whatever we as an industry can do, educate people about the cyclical nature of our industry and these short-term phenomena, I think that is something which we need. And now that can be done through education, that can be done through some nudging or from a regulator perspective also, whatever can be done on that part.
Perfect, Umesh. Education is your point. Client education is what Umesh has picked up. What's been your view on that, Ashish?
Can you repeat the question again, just a sec?
I was basically talking about an attribute that you probably may think around, which is in, if I empower you, you may change within your business, which you think can actually, help your business grow much better.
Okay. I think, in fact, one point, this may be a slight off, is our clients are just not the end investor, but also the intermediaries. Because in a way, I think trust needs to be built with them also, and partnerships need to be built with them also. Because effectively, if they have comfort with you, then they will be more, better brand ambassadors for you. Now, if I am looking at my business, the things that I think will change over the next few years are likely to be more use of AI and technology, because this was touched on. And while my point was, I think I just like to clarify my point on client engagement. My point was, for a mass mutual fund kind of thing, you may not be able to know about the individual's family and that kind of thing. Yes, you definitely will provide information, transparency, and trust at a larger level. But what I'm saying is that with the use of AI, I think a lot of aspects, both on your research, on your tracking, on information investing on one end, and client management processes, reporting, client handling on the other end. Both of these will actually change a lot, because, to come to the point, today we can't do it, but let's say, with AI, it could possibly be done for the masses also. So, like, to give an example, Goldman Sachs earlier used to have a minimum 15 million or a $10 million ticket size for their wealth clients. Today, they are happy to do it for even, like, I think $20,000, because they've got robo advisors, which take literally no time for them to do. And they are able to start off a relationship at much, much lower numbers. So I think the way I see it, this industry is going to change a lot. And AI will be the one thing I would like to focus on and change in my business.
Fair. While Umesh has concentrated on client education and Ashish has been sticking around tech advancement, Anunaya, your smile says it all. You have something out there. Please open it for us.
No, I was just thinking it becomes so difficult, when you're the third in the lot to talk. So, okay, let me draw an anecdote to it, Okay, when you go to buy gold, what do, Mohit? You buy 20 grams of gold, 30 grams of gold, am I right?
Correct.
When you want to buy a house, what do? You buy 3 BHK, 4 BHK, 5 BHK, am I right?
Yeah.
Then when you want to go PMS, when you want to buy a PMS scheme or a mutual fund, why do you want to say that I want to invest 50 lakhs or 1 crore? Why don't you go to someone like Ashish and say, look, I want to buy 32,000 units of PMS? Why value? Why not unit? So, if given a choice, if I can do something, I would really want to revisit the way we are looking at our wealth business. I would seriously want to revisit and say that rather than looking at value, why are we not evaluating on the units? What it would do, Mohit, is if I look at unit and if I say I have got a 40,000 units of a fund X, and today the market corrects, then my right side of the brain is going to tell me, which is more logical approach, is going to tell me, do average. Because same units are available to you at a discounted price. Rather than me feeling bad about it, look, my 100 lakhs or 150 lakh value actually has come down to 70,000. And look, now I'm talking about triggering my stop losses. Should I contain the drawdowns? Should I not? And this changes entire behavior. This is not happening in the house. This is not happening in other asset classes. Why? Because we do not evaluate other asset classes on the value terms. we more or less, if the gold prices come down, the first thing that you hear from your wife is, we should buy more gold. Why? Because the prices have come down. Does she ever come to you to say, sell everything because the prices have come down? So to me, I think one thing, as I started off saying, that, I would love to see the wealth aspect of the capital market related products should be looked upon at a unit level rather than at a value level.
Well, that's insightful. In fact, while you made that very insightful point, this also felt like you have been actually pushed by your home ministry to bought a bit of gold in last few months. Having said that,
I'm safe because the gold prices are moving up, so I'm
yeah.
not under the stress right now.
So, interestingly, this basically concludes the overall session for us. It's a very interesting session, and as Ashish said initially, there's something is a broad topic, that we've got out there. We could have gone ahead with it, maybe hours and hours out there. But with the limited paucity of time out there, I think we've been able to land on one very clear understanding that you guys have led through, that it is the competence, it is the focus on deliverables, that to consistent deliverables, and it is the perseverance in the business that essentially would make sure that these businesses have been growing, thriving, and the deliverables are also consistently been going back to all the stakeholders of the business out there. So with that note, I'd like to conclude this session. Thank you very much, all three of you guys, for being such lovely panelists out there. And thanks, PMS World. I'm pretty very sure while we were talking, and I was number of times recalling Kamal, because we were talking about number of P's out there. Had we been given a chance, he would have jumped in with his 5 P's, the way he basically measures the PMSs with. I'm pretty very sure that, that's also the right way to look at it. But on the note out there, guys, thank you very much. Over to you, Aishwarya.